Many people believe you need thousands of dollars to become a successful investor. But one of the most powerful investing strategies has nothing to do with large amounts of money and everything to do with consistency. That's why I decided to invest $200 into stocks every month for an entire year and track the results. No trying to time the market, no chasing hot stocks, and no complicated trading strategies, just steady contributions, month after month, regardless of what the market was doing. Along the way, there were periods of excitement, moments of doubt, and valuable lessons about volatility, patience, and long-term investing. Today, we will talk about $200 a month into stocks for 12 months, the exact return revealed. So, before we get started, make sure to hit that like button. Also, subscribe to my channel. 10. The journey started with just $200. The first investment of $200 seemed almost too small to matter. Many beginners believe that investing tiny amounts is pointless because they compare themselves to people who already have large portfolios worth hundreds of thousands or millions of dollars. However, every large portfolio begins with a small first investment. The purpose of the first month was not to become rich, it was to build the habit of consistently investing. That first deposit represented something much bigger than money. It represented a decision to stop only working for money and begin allowing money to work alongside you. The first lesson was understanding that starting small is infinitely better than never starting at all. 9. The first few months tested patience after investing for the first few months. The portfolio did not suddenly explode in value. There were no dramatic gains or life-changing profits. Some months showed small increases, while others showed losses. This is where many new investors become discouraged. They expect the stock market to provide immediate rewards. But investing is not a machine that produces guaranteed monthly income. Markets move based on economic conditions, company performance, investor emotions, and countless other factors. The early months taught a powerful lesson. Investing requires patience. The biggest returns often happen over years or decades, not weeks or months. 8. The total investment reached $2,400. By the end of 12 months, a total of $2,400 had been invested into the stock market. This number may not sound impressive compared to stories of wealthy investors, but it represents a major achievement. Many people spend years saying they will start investing someday, but never actually take action. By consistently adding $200 every month, a financial habit was created. The exact portfolio value at the end of the year depended on the performance of the investments selected and the overall market conditions. Some years may result in a profit, while other years may end with the portfolio temporarily below the amount invested. The important lesson was that the process was working regardless of short-term market movements. 7. Buying during market drops became a hidden advantage. One of the most surprising parts of the experiment was discovering that market declines were not always bad news. In the beginning, seeing stock prices fall created fear because it looked like money was disappearing. However, continuing to invest $200 every month meant buying more shares when prices were lower. This strategy, often called regular investing or dollar cost averaging, reduces the pressure of trying to predict the perfect time to buy. Some of the investments purchased during the worst market days later became some of the best performing parts of the portfolio. The biggest realization was that market declines can provide opportunities for long-term investors who continue following their plan. 6. The biggest enemy was emotion. The hardest part of the 12-month journey was not selecting stocks or transferring money into an investment account. The hardest battle was controlling emotions. When the market increased, there was a temptation to invest more because everything seemed easy. When the market declined, there was a temptation to stop investing because it felt like losing money. These emotional reactions are exactly what caused many investors to buy at high prices and sell at low prices. The greatest improvement came from creating a simple rule: invest the same amount every month regardless of what the headlines were saying. 5. Some months were winners and others were disappointments looking back at the entire year. The portfolio's progress was never a straight line upward. Some months delivered strong gains and created excitement about the future. Other months erased previous profits and created doubts about whether investing was the right decision. This emotional roller coaster is a normal part of the stock market. The biggest mistake would have been judging the strategy based on a few bad weeks or a temporary decline. A one-year period is a very short amount of time in the investing world, and successful investors understand that short-term volatility is the price paid for the possibility of long-term growth. 4. The real return was more than just money at the end of the 12 months. The portfolio showed more than a balance on a screen. The biggest return was the habit that had been created. Before the experiment, investing felt complicated and uncertain. After making 12 consistent deposits, it became part of a normal financial routine. Knowledge about the market increased, confidence improved, and emotional reactions became easier to control. Money can be lost and recovered, but the skill of understanding how to invest and remain disciplined can provide benefits for decades. 3. The power of compounding became clear. The most exciting discovery was realizing that the first year is only the beginning. A portfolio funded with $200 per month for 12 months may not create massive wealth immediately, but what happens over 5, 10, 20, or 30 years can be dramatically different. The money invested has the ability to generate returns, and those returns can potentially generate additional returns over time. This compounding effect is why many of the world's most successful investors focus on staying invested for long periods rather than constantly searching for quick profits. 2. The biggest mistake would have been waiting. Many people spend years waiting for the perfect market crash, the perfect economic conditions, or the perfect stock recommendation before they start investing. The biggest lesson from this experiment was understanding that waiting can be one of the most expensive decisions a person makes. No one can consistently predict the perfect time to enter the market. By investing a fixed amount every month, the pressure of making the perfect decision disappeared. The habit of consistent investing became more important than trying to predict the future. 1. Consistency was the real winner after 12 months of investing $200 every month. The most important result was not whether the portfolio gained 5%, 10%, or experienced a temporary loss. The biggest victory was proving that wealth can be built through discipline and consistency. A person does not need to begin with millions of dollars to become an investor. They need a plan, patience, and the ability to continue investing even when the market becomes unpredictable. The people who often achieve long-term success are not necessarily the ones who find the perfect stock. The experiment of investing $200 every month into stocks for 1 year revealed a truth that many people overlook. Building wealth is usually not a dramatic event. It does not happen because of one lucky investment or one perfect market prediction. It is the result of hundreds of small decisions repeated over many years. The total investment reached $2,400, but the most valuable gain was understanding how discipline, patience, and consistency can create a foundation for future financial growth. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.